Sit down. Today's review is for an entire industry, one that calls itself essential, invisible, and somehow above review, the crypto market makers. Let me start with the names, because these are not anonymous. Wintermute, Jump Trading, GSR, DWF Labs, Gotbit, CLS Global, MyTrade, Quant. A small handful of firms who quietly provide what they call liquidity to most of the tokens you have ever clicked on. They charge projects millions. They take token allocations as payment. And they decide from behind a bank of monitors in Zurich or Singapore or Dubai whether a chart looks alive or whether a chart looks like what it actually is. Here is the central claim of their business. We provide essential liquidity. Without us, spreads would be wider, price discovery would be slower, and retail would pay more. That is the sentence. That is the sales pitch. Hold on to it. We are going to come back to it in about 5 minutes when the receipts arrive. Specimen number 1. The wash trader. This is a market maker who, when asked to make a market, simply trades against himself. He buys from his own wallet. He sells to his own wallet. The chart goes up. The volume numbers on CoinMarketCap look impressive. Retail sees trending and clicks buy. The market maker has provided no liquidity. He has provided a costume. Specimen number 2. The allocation for volume partner. A new token launches. The project gives the market maker millions of tokens in exchange for market-making services. The market maker agrees to generate volume for the first 60 to 90 days. The volume is real in the sense that trades happen. It is fake in the sense that every one of those trades was a market maker trading with himself at a price he chose. At day 90, the market maker dumps his allocation into the audience his fake volume attracted. This is called providing liquidity. I want you to savor the phrase. Specimen number 3. The strategic investor archetype. This is the market maker who, instead of being honest about his business model, dresses it up as venture capital. We are not wash trading, he says on a podcast. We are making long-term bets on the ecosystem. The bets are made with tokens he received for free. The long term is usually the 3 weeks until unlock. And the ecosystem is a polite word for the retail investors who will be on the other side of his cells. Specimen number 4. The fair-weather liquidity provider. This one is my personal favorite because it is the only specimen whose entire job description is provide liquidity even when it is hard, and whose actual behavior is provide liquidity only when it is easy. When the market is calm, he is there. When the market is volatile, he is still there. When the market experiences an actual stress event, he turns off his machines and calls risk management. Specimen number 5. The victim complex merchant. Whenever any of the previous 4 specimens gets caught, they do not apologize. They call it competitor-driven FUD. They call it industry politics. They call it a misunderstanding of the technology. What they never call it under any circumstances is what it is. Now, let me show you what happens when these specimens meet the United States legal system. And I need you to understand something before I go on. None of what I'm about to say is my opinion. All of it is in the court docket. In September 2024, the Securities and Exchange Commission charged 3 firms calling themselves market makers, along with 9 individuals, for manipulating the markets of crypto assets being offered and sold to retail investors. C.J. Martin Estes, the SEC's Boston regional director at the time, said the defendants used bots to generate trillions of fake transactions. Trillions. In October 2024, federal prosecutors went further. They charged 4 market maker firms, Gotbit, CLS Global, MyTrade, and Quant, along with over a dozen individuals for wash trading on a mass industrial scale. Gotbit's CEO was later sentenced to prison. $23 million of wash trading services was the specific number the prosecution attached to his scheme. And here's how the FBI caught them. Not through on-chain analysis. Not through whistleblowers. The FBI created a fake Ethereum-based cryptocurrency. They called it NexFundAI. They approached crypto market makers and said, "We have a new token. Would you manipulate the price for us?" And multiple market makers on video calls happily agreed. The government recorded those video calls. The government is now introducing those video calls as evidence in federal court. $25 million in fraudulent proceeds has been returned to victims. Over 60 wash trading bots have been deactivated. 3 defendants were extradited from Singapore. And the United States Attorney's Office is still going. This is not a historical case. This is an open, expanding investigation. And none of this is even the funniest receipt on today's show. The funniest receipt is the fair-weather specimen. You remember. The one whose job is to provide liquidity when it is hard. On October 10, 2025, the crypto market experienced a flash crash. $19 billion in positions liquidated in a few hours. Market depth across major exchanges collapsed by more than 80% within minutes. Retail traders watched their orders fill at prices that looked invented. Wintermute, one of the largest crypto market makers in the world, a firm whose entire marketing pitch is, "We provide liquidity in all conditions, stop trading." Their own CEO went on the record and said, and I'm paraphrasing loosely so I can print this, that the firm's predefined trading rules were broken and they had to regroup. On the day liquidity was most needed, the liquidity provider turned off the liquidity and went to HR. Wintermute then reportedly absorbed $300 million in losses on positions that filled at prices 5 times worse than the real market. Here is the autopsy. Market making as a real job is hard. Providing two-sided quotes in a volatile 24/7 market while taking inventory risk is genuinely a difficult service, and it is worth paying for. Some market makers actually do it honestly. I will not pretend otherwise. But the industry's dominant model in crypto is not that. The dominant model is get paid by the project in token allocation, generate fake volume to lure retail, then sell your allocation into the crowd you drew. That is not liquidity provision. That is exit liquidity manufacturing. The market maker is not standing between buyer and seller to make trading smoother. He is standing between the project and the audience so the project can dump. And the tell is the flash crash behavior. When the market actually stresses the moment every textbook says a liquidity provider earns his fee, the crypto market maker turns off his bot. Because his bot was never there to provide liquidity. His bot was there to extract it. The same algorithm that happily quoted both sides all year long when the book was rigged in his favor discovers risk rules the second the book turns honest. Here is a survey I did not run, but I wish I had. In 2025, a market-making firm called Lowtech polled more than 2,000 crypto community members across 98 countries on how they feel about market makers. More than half said they do not trust them. 70% said the rogue ones should face trial. Remember, this survey was run by a market maker. They asked their own industry whether their own industry was a scam, and more than half of 2,000 people unprompted said yes. Here is what you take with you. The word liquidity has been doing a lot of work in this industry for a lot of years. I want you to stop accepting it at face value. The next time you see a new token with suspiciously deep order books and smooth volume, ask one question: who is on both sides of those trades? If the answer is the market maker, you are looking at a stage set. The buyers are extras. The volume is a backdrop. The play ends when the unlocks hit. And the next time a flash crash takes out $19 billion in positions and the liquidity providers you were counting on go silent for the entire event, take the names of the firms that went silent. Write them down, because those are not your liquidity providers. Those are your weather report. They work when the weather is nice. This is not financial advice. This is experience. There is a difference.